Um, I do have to do a little disclosure. MFS, who Max is with, is not affiliated with LPL Financial or TAR Financial, nor is today's presentation an endorsement of MFS by any means. So, all right, after getting that, so we have Max Eppley from MFS. I'm going to let him take it away. Thanks, Max, for being here.
Yeah, thank you, Taylor. And obviously, thank you all for being here, taking time out of your busy evenings, in particular on the heels of a long weekend. My name is Max Eppley. I work for a company called MFS Investment Management. We are headquartered out in the Boston area. I'm actually local. I'm right here in Troy. And I've had the pleasure of working with TAR Financial since I moved out here several years ago, pre-COVID. So as all of you know who've worked with the team, it's one of the finest teams that I get to work with. Very sophisticated, great financial planning, and of course, they care about their clients, as you can tell with putting out content like this. I would say if you have not heard of my firm before, that is totally fine. We are not a publicly traded company, nor should you know who we are. But what I would tell you this, a fun fact about my company, MFS Investment Management, we actually created the mutual fund 101 years ago, back in 1924. Before that, it was almost impossible for people to invest in America. And then back in Boston, our company became the creators of putting stocks into one portfolio. So every mutual fund you've ever seen in existence since then is derived from our product back in 1924. Now, why do I bring that up? It is not to brag. I'm bringing that up because if you think of my company, because we've been around for 101 years, you've got to imagine we've been through a lot of different market cycles, a lot of ups, a lot of downs, a lot of different administrations, a lot of global wars, whatever you want, we have been through. So a lot of the thoughts that we always put together, we always take with a long-term approach. We try not to stress on the short term because we've been through so many of these cycles. So a lot of the information that you're going to see today, we're drawing from our history and being able to prepare for the future. As Taylor said, we'll take all the Q&A at the end. Everything that you will see in front of you here today, we can get to digitally or as a hard copy as well. So anything that you'd like to go over afterwards, anything at all, we'll make sure we get that over to you. I am going to go ahead, Taylor, and I'm going to share my screen. And I just want you to audibly, because I can't see you right now, maybe just let me know that you can see this.
Yep, we're good.
So I think Taylor, we probably set the best time of all time to do a market outlook and market recap, right? Quite a crazy start to the year here. And if you think about it, what we did was at the end of the year, we tried to aggregate, as you see here, some of the top headlines that were going on, whether you watch CNBC, whatever news channel, if you read Wall Street Journal. But if you look at what we see here, this is everything that we knew was going to be part of the conversation in 2025. And if you look at the left-hand side, I'll start there with those 3 bullet points. Under the new Trump administration, bullet point number 1, global trade policy in the crosshairs. Those are those tariffs that we're hearing about right now. Trump seeks to extend the 2017 Tax Cuts and Jobs Act. Drill, baby, drill, lower energy costs for U.S. consumers, right? Onshoring that oil production. And as our eyes look to the right, we've got economy. Odds for a soft landing scenario, so a slower growth environment while trying to bring down inflation without heading into a recession. Is inflation stuck at too high a level for the Federal Reserve to compete with? Is it too persistent? Is it too sticky? And then right beneath that, the market. AI, artificial intelligence, investment boom fuels U.S. stock market return in 2024. Okay. That is a lot, right? As we started thinking about 2025 and we think about, okay, how am I going to invest for this year? We have a lot of short-term noise to deal with, as you can see here. Where are we going to allocate our dollars? Should we be allocating our dollars? This is a lot to deal with. And the reason I bring this up is not all of this is bad stuff, but throughout your careers of investing, whether you've worked with TAR Financial for a long time, whether you're just starting and will work with them, for a long time, you are going to see a lot of short-term noise over and over and over again. And what I would ask from you that you take from this is, If Taylor has me back next year and we go through this, we're going to probably see 6 bullet points again, but they're probably going to have different verbiage and it might create a little bit of angst in different areas. But this was quite a lot to deal with as we headed into this year. And obviously, as we've seen, we've started the year on a down note, which isn't necessarily a bad thing, right? Because if we think about the markets historically and you think about those bull and bear markets, generally speaking, a bull market lasts around 4 years, right? And then a bear market comes in once every 5 years. So coming off back-to-back years of 20% returns each year, I think we were due for just a little bit of a pullback there. And quite honestly, it is healthy. And I'm going to go through today quickly what we're seeing from a macro environment, what we're seeing with inflation, what we're seeing with interest rates, maybe the outlook there. And then I'm going to show you just what we're seeing from an investment landscape on the equity side, and then giving you a historical perspective on how everything's going to be okay for the long term. Okay, so as we look at the screen here, we've aggregated some of those headlines that we just spoke to on the prior slide. And what you're seeing is President Trump administration, the initiatives that he ran on, and what effect those could have with both growth and inflation. And I'll tell you what the caveat is here is that anytime we do run into a presidential election cycle and then a new president comes in, just keep in mind when they have an agenda that they run with, historically speaking, it's under 20% of that agenda actually becomes a reality. And again, I just want to bring that up because we cannot invest for speculation. A lot of these things will be coming up, but we just cannot put all of our dollars in one bucket because we think the full agenda will become a reality. But now let's look left to right about what President Trump's agenda is heading into this year and how this can affect both growth and then inflation. Now, just one thing I want to clarify. Whenever you hear growth, right, you think of, hey, our economy is growing or it's contracting. What that growth is GDP, gross domestic product. That is our economic output here. And if you think about what goes into GDP, about 70% of it is consumer driven. How much I spend, how much Taylor spends, how much all of you spend on a yearly basis, all of that is feeding into our GDP and growth expectations. And as you may be aware, inflation, on the other hand, that's just prices going up year after year. So a lot of different environments, you could see growth moving up in tandem with inflation. You can see them pulling away from each other. So we're going to go through what the outlook potentially could be if every single one of these agendas actually becomes a reality. So as I look at the far left here, if we look at extend 2017 Tax Cuts and Jobs Act, what you may see happen there is growth go up and inflation go up, right? Because if you think about if we maintain lower taxes that we're seeing right now, that means we probably have a little bit more money in our own pockets, right? So that's going to contribute to consumption, right? It's going to continue to drive up growth or at least maintain the level. And with us being able to spend a little bit more money and maintain that spending, it's going to keep inflation moving up. That doesn't mean we'll head into hyperinflation. It doesn't mean we'll head into inflation that we saw post-COVID. It just means we may maintain the level of inflation that we're seeing now. And beneath that, what you're going to see, which is something that most likely will come up over the next few months after tariffs gets tackled, is deregulation. Now, when you hear deregulation, I think the media potentially could have a connotation with that that's fear-based, right? And they might draw parallels. Okay, this is going to be the global financial crisis because we're deregulating all the banks. Well, when you think of deregulation, I don't want you to think as that necessarily as a bad thing. I just want you to think about it from a balance sheet perspective in a company and think of it almost as regulatory cost per employee head. Now, as companies grow and grow and grow in the United States, right? They IPO and then someday become a huge large cap company. As they grow, so too do their expenses, but so too do their regulatory expenses as well. You just can't really hide from them. So if we see deregulation, it doesn't mean bad things will happen. Just think deregulation means there's going to be less regulatory cost associated with a company's balance sheet. And the reason why that may drive up growth and inflation is because if you think of a company, I'm going to purely make it up. You're a company with an office in Troy here, Michigan, and you've been dying to upgrade your furniture in the office and your computer software and your actual computers as well. But you can't find the budget because of your regulatory costs being a line item there. If that lessens, that means you're going to have more money to spend on those things to upgrade your company. Again, spending on CapEx, that means growth goes up because so too does consumption. And then inflation might grow up as well. So if you think about those two parts of President Trump's agenda, if we see any movement, if we see the extension of TCJA, which seems like a likely outcome, and then deregulation potentially, those will be additive to both growth and inflation. Historically speaking, and I'll go over this, inflation isn't a bad thing, by the way. You know, we need inflation in the United States. That means we're spending appropriately. That means prices are marginally going up. Inflation isn't necessarily a bad thing. So if you see that line moving up, I feel that we've got this association with inflation that it is a bad thing that can crush us. To a certain extent, if inflation goes sky high, it can be a negative, but just know that inflation is not a bad thing for the United States. As we move towards the middle, if we look at promote energy independence through increased domestic production, right? That drill, baby, drill, onshoring oil production here, what that could potentially do for the United States looks like a pretty nice outcome there. Growth going up, right? Because if we're onshoring everything here, that means we're probably going to have to build a little bit more here, probably going to have to consume. That's great economic output. So that's going to help growth. And then you've got inflation, which may come down. The inflation that may come down here is because we're probably not paying a premium for other countries' oil production coming to the United States, which means energy prices may drop. You might see that at the gas pump, for example, and that may drive down inflation marginally. So if you think about that in President Trump's agenda, just know that growth could go up and inflation would marginally go down. And then as our eyes look to the far right-hand side, bullet point number one, okay, this is the big one, right? This is what really maybe have set off some of that market sell-off here, and that is tariffs and a possible trade war. Really, when I think of the tariff conversation right now, there was no disillusion that Trump was going to actually try and enact tariffs, right? That was part of his agenda, and it seemed to be the first thing that he was trying to tackle. I think what is sending uncertainty in the market is not the tariffs themselves, it's more so the magnitude of the tariffs and maybe the tariffs being on, tariffs being off, tariffs being back on, reciprocation of tariffs as well. I think that's what the uncertainty is. So you have seen last week alone, heavy tariffs were put into play and we saw the market drop dramatically. And then what did we see happen several days later? A 90-day pause was put on those tariffs, and it was one of the best days in market history. So the market does not like uncertainty. So it was okay accepting tariffs, but I think it's just the back and forth. And if I think forward for the next 3-6 months, however long it takes, if there isn't certainty with what countries we're putting tariffs on, what specific products we're putting tariffs on, just maybe expect to see volatility in the stock market. And again, volatility is a word that has a negative connotation to it, but just keep in mind, without volatility, we cannot see the market go up as well. So please maintain your position in the stock market now. Just know you might see intraday trading moving up and down a little bit more dramatically than what we've been used to over the past couple years. And again, what that could do is potentially drive down growth. Maybe consumption might go a little bit lower because inflation could go higher, right? With tariffs, maybe they become inflationary to a certain aspect. So I'll make it up. Maybe the auto parts, those prices go up. Car prices go up. We start spending less there, but inflation's gone up and growth has gone down. So that is a potential situation that you could see. Tariffs aren't necessarily a bad thing. And I do want to clarify that tariffs, historically speaking, may not be as inflationary as the media will tell you. They're more just a step feature to inflation. Because keep in mind what inflation is, it is year over year price increase. With tariffs, let's say we raised 25% tariff on something. That's a one-time hit. We're not going to raise it again 25% every single year. So it'll be a step up in price, but it shouldn't be inflationary over the long term because it won't be hit every single year. So this is a potential outcome, but until we understand what countries we're firmly going to tariff and to what magnitude and maybe what sectors, it is a little bit unclear. And again, that is what is contributing to a lot of the volatility. And then beneath that, immigration, right? That's a huge one for President Trump as well. It remains to be seen how much the immigration actually becomes in terms of how many people we're able to deport. We don't have an outlook there of what the number will end up being. But if you are concerned that we'll have mass deportation and we'll have to replace those workers and we'll have to pay higher wages, and that's a huge inflationary output, just keep in mind under both George W. Bush and the Obama administration, there were deportations as well in the several hundred thousands, and it really wasn't that inflationary. So again, a lot of what you're seeing on the screen here, it's a lot of unknowns, right? And it's creating a lot of angst. So what I would tell you with everything that you're seeing here, whatever financial plan Taylor and the team has created for you, whatever model you are in from an investment standpoint, you just maintain the course because they've got you tracking for long term, and these noises will dissipate over time. Taylor, I'm going to try and move this slide here. There we go. Okay, and just very quickly, as we look at inflation historically, this is going back to 2009. I'm sure we can get you the data looking further back, and we'll see way larger spikes here. But again, the target for the Federal Reserve is to have inflation sit at this red line, the 2% that we see here. And coming out of COVID, remember, because inflation is year over year data, that's why you see this massive spike here, because in 2020, we went from spending no money whatsoever to being re-released and spending a ton of money, which led to that heavy inflation amongst maybe a few other things such as supply chains as well. But right now, despite the narrative that maybe the media is running with, that we're in this high octane inflationary environment, we're still here. And honestly, if you look back, look at this period between 2010 and 2019. Why am I picking on that 9-year span? Because it was fantastic US stock returns during that period. If you ran a 10-year look back, that was great US stock returns, and the inflation may have been a little bit higher. Maybe it was a little bit lower than 2%, but over time, it did adjust down to 2%. So where we are now, I know they're trying to get it a little bit lower, but we seem to be in a nice little range bound in terms of inflation. So do not fear it at this time right now. Which leads us to celebrities, I guess, in the stock market, which is the Federal Reserve. Generally, I feel like we should not be seeing a ton of them on the TV every single day or hearing about them, but they are part of the equation that is creating uncertainty. And when you think about the uncertainty, I love this chart here, because if you're unfamiliar with this, the market tries to price in a lot of what they expect is going to happen. And if it doesn't work out that way, you may see volatility. But what I love about this is what the market has expected the Federal Reserve to do during different starting periods. And almost 100% of the time, these expectations tend to be wrong. So just as an example, this dark blue line that you see here, this is the actual federal fund rate and what it has done going back to December of 2023. This red line shows what the market had priced in right at that point in time. This is what the market thought the Federal Reserve was going to do. And they thought it was going to be heavy cuts, heavy cuts, heavy cuts, heavy cuts. And what did it do? It stayed completely flat. Then there was a cut. Then what you saw happen here after a cut in September 24, the market decided to price in this purple line, even more aggressive cuts, down, 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 down. What happened was, yeah, you saw a cut here in December 24, but again, the market is now readjusting their pricing that they don't think it could be as aggressive as it once was. And I'm just bringing this up because every single month when there's an update from the Fed, you'll probably see them more often than that given the volatility. There's going to be a new outlook on the Fed rate and where it's going to go. And I just want to emphasize we cannot trade based on expectations because the market is ever evolving, it's ever moving. Different headlines could come out, different things could happen abroad that could affect us, and it just changes the landscape. So again, I sound like a broken record, and Taylor would agree with this, but you're in your specific plan for a reason, and we cannot just move dramatically based on what the market thinks is going to happen. I almost liken this to weathermen, right? They can get the weather wrong and they'll just say, oh, it's unpredictable, and now we're giving you a new forecast. Same exact thing here. So stay the course. Okay, so what we thought was one of the larger risks to the equity market? So we've had inflation, we've had the tariffs uncertainty, Federal Reserve. If you peel back the layers and you just look at the underlying stock market, one of the larger concerns that had been brewing over time is the market concentration. Now, what that is, during different periods of a market cycle, what tends to happen is the winners tend to rise to the top of the S&P 500 and they start becoming a larger part of the market because they're more attractive to investors and they keep growing and growing and growing. And what this chart will show you is the market value percentage of the top 10 US companies, or top 10% of the US companies within the S&P 500. So just as an example, if I look at the far left during the Great Depression, the top 10% of the US companies made up 75% of the market. So that is extremely top heavy, right? And when this line, that trajectory goes downwards, all that means is the market is broadening out. That means we're having more participation from the other companies in the S&P 500. Doesn't necessarily mean it's bad. That's actually pretty healthy for the market when you have more contributors into it. So if you look at it, Great Depression, post-World War II is up almost to 70%. The Nifty 50, because we have to have cool names associated with everything. These companies are still around, by the way. I was just looking at it before this. In the Nifty 50, when about the top 10% made up 65% of the benchmark, these were companies such as American Express, Eli Lilly, Walmart, et cetera. So it doesn't mean that these companies vanish. It just means the market tends to reset. We've got our favorite dot-com bubble. And then here's where we are, or were as of the end of last year. And we had coined the top stocks, the Magnificent Seven, 7 of the most powerful technology stocks we've seen over the past 20 years. And MFS has owned those stocks in a variety of different fashions in different portfolios. It doesn't mean they're bad, but the risk that was brewing was we were pretty much at all-time highs when it came to market concentration. And what that means for the benchmark is in the S&P 500 that if 1, 2, or 3 of those companies tend to falter simultaneously for different reasons, it may affect the overall return of the S&P 500 because they make up such a large portion of it. So right now, this has not been updated through the first quarter yet because that's just ended, but I'd imagine this number has started to trickle down here, meaning we're getting more participation from other areas of the market, such as the value space, an area that we haven't really loved as much just from a performance standpoint, but it's now contributing more as growth stocks have started to decline. And what I love is this. Generally, we've hit a market concentration peak once your old high school buddies tell you what to invest in or what your neighbor gives you unsolicited advice is. And what this is showing you is going back to the Great Depression all the way on the far left-hand side is these are the top 5 stocks during each of those periods I just referenced. And what you're going to notice is some tend to stick around, maybe, but then some vanish from the top 5. And I bring this up because if you look in 1929, now that was 100 years ago, so I know things have changed since then. You've got General Motors, General Electric, US Steel, Standard Oil, Union Carbide. Look at the difference 50 years later. Not a lot of overlap here. And as we look left to right, it's ever changing as the world changes as well. And I just bring this up because these companies that you see here, the top of 2024, they're not bad companies. I'm just telling you that maybe in 20 years, if the world changes, these might not be the top 5 stocks there, which is why you own a diversified portfolio with TAR Financial, because if you're just picking the winners at the moment and you get them at the wrong time, like we saw here, and you're over just in only a handful of stocks, you might be owning them at the inappropriate time. So we just cannot expect current dominant stocks to always be the leaders in the future. So if you think about what does MFS look for and other strategic partners that you may be investing in, well, it comes down to fundamentals. And I truly feel that we have lost touch with what fundamentals can do for stock returns. And what does that mean? Well, at MFS, if you want to look for really, if you want to write this down about what specifically we look at for a lot of our equity positions, we tend to look at a company's cash flow. How much cash they have on hand, how much cash they have coming in relative to paying out. And then once we look at cash flow, we look at profit margins, right? If you've got good cash flow, you've probably got good profits. Then if we look at profits, if you are a company with great profits, you tend to have pretty good earnings. And what you have seemed to found, looking historically back, is earnings drives a share price. And if you have good earnings, your stock returns are fantastic versus companies with negative earnings. Now, we tend to have lost this with a lot of speculation with artificial intelligence. There's a ton of stocks that have run up that have no earnings or negative earnings, but because they say artificial intelligence on their earnings calls, the stock tends to pop, even though there's no fundamentals behind it. And you tend to see these speculative spikes happen during the tech bubble or during the Great Depression, right? That's when you might see a little blip up of negative earning stocks, because that's when people just are trying to get rich too quick. So what I'd ask you to look at when you think of a company, when you think about how we invest, and again, it's not an endorsement for MFS, a lot of companies do this, including Warren Buffett, you just always look at earnings. And if a company has strong earnings over the long term, as we can see here, earnings drives the share price. If you're in those high quality companies, you are going to be A-okay. So that's what we've got going on. We've got what is President Trump's agenda, how that can affect growth and inflation. We've spoken to the Federal Reserve and then what we've seen historically with inflation and what you should be looking at primarily as you evaluate stocks and as you work with the team. It's companies with positive earners. There is something that I wanted to bring up. It's the historical look back on calendar year returns and why volatility and downside is actually very, very normal to the stock market. Okay, so what you are looking at here is the S&P 500 every single calendar year going back on the far left to 1980. Now, every bar that you see, that is where the S&P 500 finished during that year. But what these dots do represent are at any given point in the year, what is the maximum drawdown that the market saw then? So I'll make it up. In 1980, or I'll give you an example, excuse me. In 1980, the stock market returned 26%. But at some point during that year, the market sold off 17%. Could have been in January, could have been in March, whenever it was a 17% decline, but the market finished up 26%. Now, as we look left to right, we can pick any calendar year we want, including all the way here on the far right-hand side, our most recent years. And what you will notice is it is absolutely inescapable that at some point during the year, we will see a drawdown. Sometimes it's lesser, right? In the mid-1990s, it was only 3%. That was the worst drawdown we saw that year. Sometimes it's 2008, where it's 49%. The reason I love this chart so much is every single year, you will see a period where stocks sell off. That is like me moving from Arizona here to Michigan, and I call Taylor up and I'm like, hey, you think it's going to snow this year in Michigan? Taylor's going to be like, yeah, it's going to snow. So get your gloves, get your shovel ready. Same thing for the markets here. Every year you can probably expect some type of downturn. On average, it's about 10%. So don't be fearful. This is very normal. I just think it feels a little bit different because of the noise and because of the magnitude that we've seen come down. But quite honestly, that recent 2022, where we saw a 25% downturn and it finished at 19%, it almost feels like an afterthought. It almost feels like it didn't even happen because we're replacing that noise with just new noise. I mean, if you ask someone, I don't think they remember it being as bad as it was because it just ripped right back up. So just know volatility cuts both ways and it is normal. And two more slides here and then we can open up to questions. But what we've also aggregated, as I said at the front end here, this is going back to just 1940. So this is actually longer than what we just previously saw. And this is the difference between bull and bear markets. The line moving up, as you can imagine, is our bull market, and the red line moving down is bear market. Now, we can look at any period, but what you're going to notice is bull markets tend to last longer, and they're more fruitful than the sharp declines that we see with bear markets. We actually aggregated the data for you here. The average bull market return is right around 141%, and it lasts just over 4 years. Conversely, the average bear market return, you lose 31% and it lasts just over 1 year. I would wager if I told you every 4 years you are going to have phenomenal returns and then just 1 year, right? We'll see a sell off, but then 4 years on average will go back up and then 1 year down. I think that's a very good trade-off to get you to your financial goals. You won't be 100% in the S&P 500, but this is the idea behind it. Now, what tends to happen to a lot of people, I have family members, I'm not trying to be hypocritical, who have done this as well, but when you get to these bear market periods, and sometimes they do last longer than others, it is painful to see all that money that you've built up in your life start to go lower and lower and lower. And you will get to a point where you will call TAR Financial and you will ask, should we be moving out of the market? And if you don't call them, you might even be just thinking it to yourself. And that is such normal human behavior. But I'm telling you that even missing just a few days of the market could be so detrimental to your returns long term. This is going to be sent to you as well. I'll send it to Taylor after this. But what we ran back was, if you had invested $100,000 and you just looked back over 20 years, and if you were fully invested right here at the bottom, 100,000 over the last 20 years brings you to $717,000, right? Now, if you had missed the best 30 days, right? You call the firm here and you say, I just can't take it. I just need to sit out until we get more clarity. And you miss the best 30 days over a 20-year period. Think about how many trading days that is. If you miss 30 of the best days, your 100,000 only grows to 129,000 over 20 years. And that's just if you've missed 30 trading days. Now, if you just say, okay, well, what if I miss just 10 days, right? What if I'm only out for 10 days? Your 100,000 over 20 years grows to 328,000. So I bring this up because the best days in the stock market, historically speaking, tend to happen right after the worst days of the stock market, as indicative of what we saw last week, right? So even missing just a few of those best days, in particular last week, it can really cut into your long-term return. So just think about this, right? You want to stay invested. Sometimes you need to pull out the money because you actually have to, and that is totally fine. It doesn't make you a bad person. I just like to illustrate this because maintaining your long-term position can be very fruitful versus even sitting out just 10 days. Now, with that being said, Taylor, said a lot. We're right at just over 30 minutes. I'm going to pass it back over to you, and I'll take any questions that we have right now.
Perfect. Hey, thanks, Max. That was great.